Hi, this is David Daughtry at Copperwind Financial. On this day's talk, we're going to discuss a little bit about the impact of a rising U.S. dollar and what that will do both from an economic standpoint and also from a market standpoint. And what I want to show you first here, I nearly always have lots of graphs. What I wanted to show you first is what we're seeing here in the U.S. And what we're seeing is the S&P year to date doing quite well. I mean, we had a pullback where it went down nearly to zero, but it's recovered all of that. But if you look at it compared to U.S. small company index, small companies are barely positive year to date. And I think one of the things that's causing that is you are seeing a lot of money coming out of China, out of Russia, probably even out of Japan, the Middle East, and some out of Europe. That's coming to the U.S. For political safety reasons. And it is typically going, it appears, into U.S. real estate in the big markets like New York, Los Angeles, and San Francisco. And it's going into large companies, companies that are known by those foreign investors, which typically are the large multinationals. And so that's what you're seeing here. Same way if you compare it to MGK, which is the Vanguard mega cap companies, 50 billion and more, it's even doing better on the very largest companies. So I think that's what you're seeing, and that may continue, because typically you don't see this big of a difference as far as when you're looking at the same market as far as the U.S. market, the difference between small caps and large caps. The other thing that we are seeing is if we look here, and I'll compare it to the international markets, developed international, and this is looking at Japan, Australia, Canada, and Western Europe. They're down nearly 5% versus the S&P up, over 10. Big discrepancy there. So I think that's being caused, a lot of it, by the strong dollar here. Now let me show you what's occurring. There's let me grab a couple of things here. One of the things that you're seeing is all of these markets going up over the last few years are probably being fueled a lot by the central banks. And this is looking at the balance sheets of the largest central banks, the Fed, the European Central Bank, the Bank of Japan, and the Bank of England. And this is the assets that they own. At the start of 2008, they had about 4 trillion in assets. Today, nearly 11 trillion, and that's money that's just been printed out of thin air. And they've typically used that in the U.S. To buy bonds and mortgage-backed securities. In Bank of Japan has actually used it to buy stocks in Japan and real estate investment trusts. And so you're seeing them use it in ways that are very unconventional, that we never thought a lot of the central banks for the large developed countries would ever use it. Now, the U.S. has stopped our quantitative easing, or the printing of money, as of the end of last month. But the European Central Bank has stepped up and said they will buy as much as $1.3 trillion worth of European bonds. And the Bank of Japan has basically increased. They were doing a lot, but now they're doing even more. They're doubling down and will basically be doing about 3 times what we were relative to their GDP. They'll be printing about $1 trillion, and they're a third our size. So that's having some impacts in the markets, and I'll show you that. Here is, let me blow this up so it's a little bit larger to see. This is looking at, over the last 2 years, FXY is an exchange-traded entity that tracks the value, basically, of the yen, and it's down 30%. This is UUP is the U.S. dollar that goes up when the dollar goes up. So for a long time it was going sideways. In the last year, you've seen it start to go up pretty significantly. Part of that's with the Japanese, but also some of it in the euro. Now what that has done, in fact, let me get back here and I'll show you what that has done to the Japanese market in the last 2 years has been quite astounding, because just as the printing of money here really helped the U.S. market, the printing of money over there did the same thing, but even in a bigger manner over the last 2 years. This is looking at the Nikkei, which is basically the Dow equivalent over there. And so if we look at it over the last 2 years, you went from 10,000 up to over 17,000. And so when we compare it to, well, we can compare it to a couple of things. There's the Dow, so it's up 84. The Dow's only up 46. But you can also compare it to the developed markets of international, which are up 17 versus 80. So you can see what printing trillions of dollars will do for a market, and it's clearly helped that market. Long term, it's going to be a negative. But to understand why the Japanese did this, it's interesting. I'll pull up another. This is the consumer price index of Japan. What you see is, we can just look here, moving that to basically the last, well, I'll just show you here. But what you're seeing is basically from 94 until now, they've had no inflation at all. And if you compare that to like the U.S., that has not been the same case in the U.S. Here, if we're looking, and FRED is the Federal Reserve Economic Database. So what you see here is, you know, since 2000, if you, in fact, we'll move this up so that we're closer, you've seen a steady increase. The only time we had a decrease was in the Great Recession in 2008, 2009. So they're trying to get inflation to come up because their stock market has done virtually nothing. In fact, if I look here, I'll go back to show you their stock market and say, oh, that was a great time. Let me kill it here, and then we go back 10 years. And you look and you say, in 10 years, they haven't done anything. And if you go back and look and say, okay, what's it done over the last 20? Well, you were at 40,000 nearly in, actually 38, 39,000 in 1989. And you know, now you're less than half that. So you can see why they're doing something dramatically different. I think it will end badly. I do think what you're going to see with the dollar strengthening, you are going to see money coming to the U.S. because as our currency goes up, if someone has invested in the U.S. Stock market or real estate in their currency, when the dollar goes up in value, in their currency, their investment goes up in value, even though the stock market wouldn't even have to go up in value here. But it is going up in value because money is coming in. How long that lasts, nobody knows. But did want to point that out. That's one of the reasons that we've got very little exposure on the international side, even though on the emerging markets, that's where the growth is. But it's clearly not where the market action is. So anyway, just wanted to point that out. Hope this was helpful, and we will talk to you later.